All right, let's just jump right into it. Welcome to today's Explainer, where we're tackling what is honestly one of the most complex, high-stakes puzzles in global trade right now: cross-border money flows. If you're doing business internationally, you've probably already figured out that setting up the right business structure isn't just some boring legal formality. It's the absolute bedrock of your financial security. So today, we're going to tear down a real-world case study and look exactly at how you build a compliant, bank-ready foundation right from the ground up.
Everything we're talking about today really starts with this massive million-dollar question. How do you legally move money across borders? Look, moving physical goods from point A to point B, that's just logistics, right? We've got shipping containers and cargo planes to handle that stuff. But moving the cash, getting paid across totally different jurisdictions while trying to navigate all those foreign exchange laws and completely different tax codes, man, that is the real puzzle. And as you'll see in just a minute, one wrong step here can literally freeze your funds or trigger an absolute nightmare of compliance headaches. So here's our blueprint for today. First, we'll outline the cross-border dilemma. Second, we'll introduce EZIPD, your business architect. Third, we'll explore Model A, the trading company route. Fourth, we'll look at Model B, the commission model. And finally, we'll wrap up with the expert verdict. Okay, let's get into part one, the cross-border dilemma. Moving goods versus moving money. So the actual supply chain logistics here are pretty straightforward. We have a Chinese supplier who manufactures some goods, and those goods then need to be exported to a buyer all the way over in Peru. Sitting right there in the middle is our anonymous client, acting as this crucial bridge connecting the two parties. But remember what we said earlier, the physical movement of those goods is really only half the story. Here is the kicker. Our client plans to capture a 10% margin on this transaction. And, they anticipate repeating this exact type of business well into the future. Because of that, they absolutely need to know right from day one that their financial structure is completely bulletproof under both PRC tax and foreign exchange rules. They really can't afford to get this wrong because, honestly, 10% of a massive global transaction is just way too much money to leave exposed to regulatory risks. Moving on to part two, EZIPD, your business architect, building bank-ready foundations. Now, I absolutely love this guiding philosophy from EZIPD. We see ahead, we handle all, you see everything. It really hits the nail on the head regarding their whole approach. They aren't just sitting around waiting to react to problems, they are fiercely proactive. They provide the whole shebang, complete end-to-end solutions. From setting up the legal entity to opening the bank accounts, they do it all, while maintaining total transparency so the client always knows exactly what's going on with their documents and deadlines. So before a single cent ever moves, EZIPD deploys a pretty genius tool they call the structure check. Instead of just guessing and throwing a business model at the wall to see if it sticks, they conduct a totally comprehensive review to spot and mitigate risks way early on. They get all the entity, secretarial, and tax details perfectly aligned into a single bank-ready dossier. Why should you care about this? Well, it's simple. Doing all this heavy lifting up front drastically shortens bank approval times, and we all know what a nightmare those can be, right? It essentially de-risks the entire cross-border settlement process. All right, let's explore our first option in part three. Model A, the trading company, or WFOE route. Let's trace the actual product flow here. First, the Chinese supplier sells the goods directly to the client's Shenzhen WFOE. That's a wholly foreign-owned enterprise. Now, because that Shenzhen entity legally owns the goods, it has to arrange the export process itself, and it signs the final sales contract directly with the customer in Peru. To actually pull this off, EZIPD makes it clear that the Shenzhen company must hold an official import and export license. And this brilliantly illustrates how the cash flows under Model A. Since the Shenzhen WFOE is the official exporter on record, the customer down in Peru pays their foreign currency directly into the Shenzhen WFOE's bank account. Then the Shenzhen entity turns around and pays the Chinese supplier in the local currency, RMB. This centralized cash flow, it's perfectly legal under PRC regulations, and it manages the foreign exchange or safe risks really, really effectively. Okay, but what about the taxes, right? Always the big question. Under Model A, any net profit left sitting in the Shenzhen company is subject to profit tax. Though, obviously, if your operational expenses manage to wipe out that profit, no tax is owed. Interestingly enough, EZIPD points out that there is no standard value-added tax, or VAT, applied to the WFOE in this specific setup. But the absolute biggest takeaway here? Scalability.
If both the supplier and the WFOE are general taxpayers, this structure lets you apply for some highly lucrative export tax refunds down the line. So yeah, it's definitely heavier on the operational side, but it is custom built for massive growth.
Okay, let's pivot and look at the alternative in Part 4. Model B, the commission model, also known as the trading agent route.
So the cash flow here is just incredibly streamlined. The customer in Peru completely bypasses the Shenzhen entity. They just pay the Chinese supplier directly for the goods. Simple, right? In return, the Chinese supplier funnels that 10% margin we talked about back to the client's Shenzhen WFO in RMB, acting basically as a commission. The Shenzhen company literally never even touches the foreign currency coming out of Peru. Because the Shenzhen company in this scenario is acting as an agent rather than a true trader, this revenue is treated strictly as service income. EZIPD notes that while profit tax still absolutely applies, the VAT situation changes quite a bit. You're going to pay a 1% VAT if you're registered as a small taxpayer, or a 6% VAT if you're a general taxpayer. And, most importantly, yes, this structure is entirely compliant and perfectly legal under PRC regulations. No shady business here. Let's look at these two side by side. Model A gives you this incredible control and the potential for those sweet future tax refunds, but it means you have to secure an export license and manage the entire physical export process. Model B? Well, it's beautifully simple. No export license needed, payments go directly where they need to, but you do trigger that 1% to 6% VAT on your service income. It's that classic business tension. Do you want operational complexity with long-term perks, or do you want immediate efficiency and simplicity? Which brings us to Part 5, the final expert verdict, and EZIPD's ultimate recommendation. EZIPD actually uses this really brilliant logic matrix to help make the decision. The right structure completely depends on the current state of your business. If you've only got a small team in China and your transaction volume isn't massive just yet, EZIPD usually recommends Model B. It's just so much easier to manage. But if you have a larger team and you're rapidly scaling up your operations, Model A is the clear winner. Specifically so you can capture those export tax refunds down the road. So what was the final verdict for the anonymous client in our case study today? Well, looking at their current setup, EZIPD advised them to move forward with Model B for now. It keeps their team lean, it keeps the cash flow delightfully simple, and most importantly, it guarantees 100% compliance from day one. And the best part? They can always evolve into Model A later as their operations continue to grow. And that brings us to the end of our structural breakdown today, which leaves us with a pretty high-stakes question regarding your own operations. Is your business structure truly bank-ready? Or are you maybe operating under a fragile model that's just waiting to trigger a massive compliance freeze? It might be time to stop guessing and get a structure check of your own. Thanks so much for joining me on this explainer, and keep learning out there.